buying real estate in 2023. In today's video, we're going to talk about how to buy real estate through a recession, what asset classes to buy, and what products you can use to buy these assets.
We're also going to take a look at what the rate environment is going to look like and some of your investing strategies moving forwards. So if you're looking to buy real estate in 2023, stay tuned. Hey guys, Ehren and Josh with the Findlay Mortgage Team, and today we want to talk about what it's going to look like in 2023 when it comes to buying real estate. There's been a lot happening in 2022. We've seen rates increase quite significantly, a little bit of fluctuations in the fixed rates, but heading into 2023, right now rates are sitting at around 6% across the board when we're looking at least A lenders and B lenders heading up into the 7%. Real estate prices are down 20, maybe 30% in some markets, with some experts predicting another further 10% decrease by the end of 2022. So we just want to talk about where we think the market's going and what some of the strategies investors are going to have to use to be able to continue buying.
Yeah, and a lot of our clients have seen challenges in this market, and this video is intended to just kind of outline what strategies and what products you can use to be able to continue to buy and scale your portfolio in 2023.
A few things that we think are going to be affecting the market moving into 2023 are going to be, the continuing lack of supply with housing. Developments are probably 2 years, 3 years behind right now with the effects coming from COVID, material shortages, and the increase in cost. So that's definitely going to have an effect on the market, as it always has been. Immigration is continuing to increase year over year. We're getting close to 500,000 new immigrants every year, and again, coupled with that, lack of housing, that creates an issue. There's a large competition between the working immigrants coming in versus the working Canadians, and who's going to be able to get into these houses. And you got to mix in the investors in there and some of these big funds that are buying up the single family homes. So there's going to be a shift in how these buyers are buying and what they're targeting. We are in a recession, or at least heading into a recession, depending on who you want to talk to. So there are going to be some economic factors that I think are going to affect the market as well too. We've definitely seen that with the rates increasing. Like I mentioned, the overnight lending rate, as of right now, we're sitting at around 3.25, with some of the targets around 4.5 by the end of 2023. So, if you're looking at your rates, that's something that you want to keep in mind when considering, your strategies for purchasing.
Yeah, when looking to purchase next year, all these factors are going to affect pressure downward. So, we've seen a major decrease in value in a handful of different types of markets. Some have seen more of a decrease than others, but when we're looking at the decrease based off of the overnight lending rate increasing, it's only so far you can go. As you said, those economic factors are going to come into play, and there's still going to be a supply shortage. There's still going to be people looking for jobs, looking for housing, and depending on if we go into a stagflation situation, people are still going to need to find a place to live. I think that there's only so much downside that we can see with rates increasing, and there's going to still be a demand. Now, the challenge with some investors now is finding an investment that is going to be viable. So some of the challenges we're seeing right now and probably into 2023 is determining your as complete value. What is that going to look like? How do you determine your as complete value when you are in a down market, especially when you've seen such a decrease in value so fast? The majority of people who were looking to invest in real estate last year were doing flips. They were very quick money. You were in, you were adding value, and you were out because you were in an appreciating environment. It was very easy to make money. We're seeing a shift now. We expect a shift from investors into maybe more sound investment strategies. We're seeing quite a few people move into the multifamily space. Cash flow is going to be something of concern. As interest rates rise, you're going to see things tighten up, and investors are going to focus more on your monthly cash flow situation and less on the quick buck of flipping in a market that's increasing.
Yeah, I think your ability to time a market right now is going to be very challenging. If you're looking at using other people's money, which was all the hype in 2022 and 2021, you have to expect that you're going to have a lot of your money left in these projects. In terms of what strategies to help get that money back out, I think your simple, just like aesthetic and curb appeal type renovations aren't going to cut it anymore. I think you're going to be forced to do some sort of conversion product. I think a lot of like infill is almost going to become like the new burr, where you're taking that single family or maybe that duplex and you're just knocking it down, rezoning it for medium or high density, and building some sort of fourplex 5 and up type building. And that's really going to be what's going to be able to get you back onto that capital producing type strategy and allow you to get the majority of your money back and allow you to move forward. I just don't think the regular burrs are going to be as competitive anymore. And if you're looking to buy and hold after that burr, and talking about cash flow, the only way to really get cash flow at this point is just increasing the amount of doors, because the rates aren't really going anywhere right now. Hopefully by the end of 2023, they're starting to come down a little bit, but a single family home, a duplex right now just isn't quite cutting it when it's coming to cash flow. That's your strategy.
No, completely agree, and it's interesting to see how the equity markets are taking an absolute dive right now. And from the secured private lending perspective, usually we see a lot of money flow into private lending on the secured side. So you're gonna see an influx of hard money being put into the market because of the guaranteed return on investment, or guaranteed decently sound investments based off of an actual valued asset. We are seeing a significant amount of money do that right now, but as we move through this recession, real estate is a sound investment, and if you have a lot of downside in your equity in the equity markets, a lot of people are expecting that return for retirement, for long-term strategies. I do foresee people transitioning some of their portfolio, some of their investments into real estate as we see a decrease in value. And I foresee most of it happening on the commercial side. I think that as rates increases, qualification is becoming more difficult for the majority of people. Your income isn't rising at the point in which it's offsetting the total cost of borrowing. So, as you said, economies of scale, it makes sense to move into larger buildings with more units. It's going to become more challenging for the average investor to do that. And I foresee, those 5 units and up projects to become more popular as we move through this recession for a handful of reasons. One, affordability. I think that if you put more weight on the asset itself and the debt servicing of the asset, it's going to move the personal qualification in regards to total income away, and it's going to allow people to invest soundly and force appreciate a property based off of their specific asset instead of how the market is perceiving the sales of assets in that area.
Yeah, I think personal debt servicing is definitely something to take into consideration when the majority of Canadians and probably people across North America rely on the equity in their house to refinance and pay off that debt. We see some individuals take on $60,000 to $80,000 of credit card line of credit debt, and just every year they kind of refinance their house and they pay that down. If you're down 20-30% in that equity, you don't have that ability to refinance, pay that debt down, which means you're going to be carrying a lot more of that moving forwards. On the burrs, if you're relying on your HELOCs, lines of credits, your revolving lines, and you're not getting all that money back, again, you're carrying more debt moving forward. So switching to some sort of asset class that takes the focus off of your personal debt servicing and puts it more on the asset is definitely going to be, a good strategy. I think, residential real estate is going to be a good option if you're just looking to build a little bit of a nest egg moving forwards, or something that you want to be able to pass down to your children, something like that. Because like we mentioned, that residential cash flow is slowly just dwindling away as the market increases in the rates. Even though market rents are on the rise, I just think residential real estate on that 1 to 4 unit side isn't going to be as strong with the cash flow. But taking a look at the commercial side, when we're taking a look at what type of asset do you want to use to kind of protect yourself against down markets, multifamily real estate is one of the only asset classes that really increases value on paper in down markets. During recessions, you see a lot of affordability decrease, so we're getting more of the home buyers move into the rental markets, which means there's more competition on the rentals, which means your market levels of rent are increasing, and When multifamily is based on an income producing approach, on paper your building value is going up. So although you may not realize that right away, 2-3 years down the road when you go to refinance and take advantage of that, those rents are just at that much higher of a value, and I think that really protects the commercial assets.
Completely agree, and I think there's going to be a very specific opportunity for essentially from now until I think maybe halfway through next year, because cap rates are on a lag approach, right? It takes time to be able for a cap rate to expand, and we've seen about a 25% increase in rent due to buyers getting pushed into the rental market, especially in Ontario. The opportunity to purchase these multifamily assets in 2022, the end of 2022 and start of 2023, the lift on those assets are going to be astronomical because you have rents that are probably 50% of what market rents are at the moment. So the ability to be able to increase the value of a multifamily asset is huge, and I think it's just growing. And if people take that opportunity in 2023, I think it's going to be where most of the winners are made.
I think it's a good opportunity to take advantage of some of the commercial products that we have that are geared towards markets like this and new development and repositioning. So we have the CMHC products, the standard rental product where you're 85% loan to value, 40-year AM, a good product out there, provides great cash flow. CMHC brought out their new product this year, the MLI Select product. You can get up to 95% loan to value, a 50-year amortization, really geared towards new development, which is going to be a great option for a lot of new developers and mid-level developers. It's great structure. And then we have we just got our preferred status this year with one of our big bank lenders, so we have the ability to underwrite at 1% debt servicing, which is great because a lot of other lenders are debt servicing at 1.15, 1.2%. So that means that we have a lot less borrowers that are going to have to go into private financing to do the repositioning versus being able to get a bank product. And these guys are allowing 75% loan to value. They'll cover up to 75% of your loan to cost, so they actually cover some of your renovations. Interest only on the repositioning. You're sitting around a low 7% right now, but with interest only, it's actually cheaper than a lot of the amortized options that are out there. And then a 2-year term and right into CMHC to help on that cash flow. So a lot of great options available to kind of help you get into if you're looking to get into commercial real estate, or if you're a mid-level investor looking to get into that higher end. Lots of great products out there.
I completely agree, and I think it's interesting to hear from the conversations we're having with our capital partners about where the market's going and what's happening. You talk on the residential side, and it's a lot of doom and gloom right now. There's a lot of we're being very cautious. We're reducing our loan to value. We're not going into secondary markets. As we talk to our private capital partners, or we talk to CMHC, or some of our larger commercial banks, they're bullish. They're extremely bullish on this multifamily commercial stuff right now. That CMHC product, they're pushing higher density, better multifamily housing. They want that. We need that in the economy right now. And when you talk to these banks, we're seeing that they are gearing all of their financing towards helping these investors or developers create these types of assets. So I think in 2023 this is going to be a huge push, and I don't think that it was by accident that the MLI product was created before this is happening. Now, I'm not wearing a tinfoil hat and saying they knew it was coming, but higher density, higher loan to value, higher amortization products in an increasing rate market, it's almost like the perfect storm of a product that was created specifically for this moment.
Yeah, and I think it's there to help the mid-level guys as well too. Like on these infill type projects, if you can take a single family home and it's in a specific zoning, and you can build, like I said, medium density is usually around 8 to 12 units or 5 to 8 units, but if you have the ability to get that done and you can build 12 units, you can set that market rent right from the get-go. And the MLI Select product, even though it's a point-based structure, there's still a couple different ways that you can get that full 100% or 100 points and allow you to get your 100% structuring of 95% loan to value and a 50-year AM, and you don't always have to focus just on the affordability. So you can keep full affordability and be able to get your top tier structuring just depending on how you do it. But imagine walking away with 12 units at full market rents. That's the type of cash flow that people are going to be looking for moving forward, but it's also the type of buildings that we need moving forward.
Completely agree, and I think as investors start to realize that maybe the alternative investments in other asset classes just aren't doing it, and they might not do it for the next 2 or 3 years, real estate tends to keep up with consumer prices and inflation. And usually in markets where you see a decrease in value, people who have liquidity or who have cash, I foresee them moving into the real estate market and taking advantage of the lower prices.
Yeah, I think being liquid is probably the biggest thing that everyone's talking about right now. Prices, with prices being where they're at, there's going to be a lot of opportunities to buy over the next 3 to 4 years. You want to be able to pull the trigger when a deal arises. So obviously making sure you've done all your due diligence, running your numbers, having your power team in place, and having the money to be able to get it done. Like we were just talking about, borrowing other people's money right now is really going to mitigate your margins. You're not going to be able to get as much of your money out, which means you're not going to be making as much of your money, which means your capital partners aren't going to be making as much of their money either. So having your own money and being able to get that done on your own without having to rely on your partners means you're putting a lot more of that money back in your pocket, obviously. But just being in a position and being ready to buy, I think is going to be key for a lot of people, because when the movement starts, I think it's going to be a real swift movement of buying up, and I think properties might start going a little bit quicker than what some people might think.
Completely agree. Yeah, staying liquid, whether it's managing your portfolio costs, unexpected costs, and just being able to take action, it's the most important thing. And a lot of our clients have restructured their portfolios to wait for this. Most of them are sitting in cash right now, or sitting in very safe investments that are kind of offsetting inflation, probably taking a little bit of a loss on the money while it sits there. But the opportunity cost, we keep hearing that opportunity cost, waiting. All wealth is made in down markets. Nobody wants to buy at the top. Why would you try to buy all the way up if you could buy down? And then as the market cycle increases, you make your wealth. And I think a lot of people are prepared, or are preparing right now. If you haven't prepared, there are still ways to access equity in your home. We are seeing a shift on the residential side to maybe looking at second mortgages, accessing equity in different ways than you normally would, or just utilizing your portfolio as a tool, whether it's cross-collateralizing into a multifamily, using the equity without breaking your current mortgage. There's a handful of ways that you could access the equity without necessarily breaking your mortgage. So there are still a ton of creative options in the market. There's a lot of great deals. And don't think just because there's doom and gloom in the economy right now that you can't take action on a property. If the numbers work, take action. There's still some phenomenal deals out there right now. And as we move into a situation where there's more inventory in the market, you as a buyer are going to have the ability to make strong offers, flexible offers, VTBs. Talk to your brokers, talk to your agents. You'll be able to, create opportunity for yourself that wasn't necessarily there 6 months ago.
Yep, no, I totally agree. And I think, this year's been a good reminder that, real estate, it does have a peak. You can't have 70% appreciation year over year. It's not a realistic model. So it's a good reminder to just be aware. You can get timed, or you can get stuck in an unfortunate time in a market. You do have to look out for the factors. But it's also good to remember that these market cycles happen. We've seen, things like this happen prior to 2008, 2009. We had 2008, 2009. We had 2017, and we just went through 2022. So the markets do recover. Just put yourself in a position to be able to take advantage of that. Take the reminders of the past moving forwards and put that into your strategy, and keep the due diligence high, and I think everyone will be fine moving forwards.
I completely agree. I think that doing due diligence, planning properly, staying liquid, and being able just to understand that this is a cyclical thing. I think one thing to take away, guys, is managing expectations as a real estate investment. I think a lot of people lost sight of the fact that there is downside to a market, and this is a stark reminder that to mitigate over leverage and to do things properly and to understand the markets that you're investing in, because sometimes as Ehren said, markets are cyclical, and if you get caught at the top, it can be a tough situation. So there's a handful of opportunities that are about to show up. So if you guys have any questions and you need to navigate these waters, Ehren and I are always available. Please reach out to us. We're here to add as much value as possible. If you guys enjoyed this content, please hit the like button, share button, subscribe button. You can follow us on Instagram or our new TikTok channel. So feel free to give us a call and follow. We really appreciate it.